tomorrow. I'm sorry, early final. It's a week from tomorrow, 1:30 to 3:30. It's a week from tomorrow. Okay. So I'll send out the directions, which room. I think you have some of you have a morning exam that day and negotiation or whatever it is. So don't burn yourself out, because this is the exam that really matters. Don't tell them that. Right? The second is your regular final is. Okay, can you hear me better now? No? Okay, the second is that your regular final is on May 11th. Okay, that is, I guess, 2 weeks from today. Is that right? 2 weeks from today. That will be in this room. So again, I will send the directions out. It's 11:15 to 1:15. I think it's some. Remember, the times get weird for the finals because everything gets staggered. Oh, so I'll send out the exact times. I'm not sure what the exact time is, but I will send that out as well. Right? The final will cover everything, obviously, which is a lot of things. Okay? So that's all I wanted to say about that. Your final project is due a week from today. As those of you in my corporate finance class know the routine, I will send you an email later this week with a spreadsheet where I will ask you for summary numbers from your project. What's your DCF value? What's your relative value? What's your recommendation? 5 numbers or 6 numbers for your company. If you can send it back to me by Sunday night, I'll put it together. On Monday when we meet, you can see what percentage of you found undervalued companies, how many found overvalued companies, what the 10 most undervalued companies were, overvalued companies were. So for that to work, though, I need the data back from you. Okay? Any questions in general before we start? Louis? I'm sorry? The early exam covers everything, so there is no advantage to taking the early exam. Our last class is on Monday. I will assume that you will learn everything through Monday and be ready on Tuesday. Okay? So keep that in mind. I mean, we'll be done with the stuff for the class Wednesday, day after tomorrow, actually. Monday's class tomorrow for review. So let's talk about acquisitions. How many of you are taking the M&A class or have taken the M&A class? If you think about what you covered in an M&A class, much of it is spent on tactics, right? Tactics, the deal making, the structuring of the deal. Valuation almost is an afterthought in these classes. Oh, now we have to do the valuation. Let's get it done before we actually do the deal. Okay? So I'm going to give you a presentation that I put together, I don't know, 5, 6 years ago, and I'll give you the basis for this presentation. A friend of mine who runs this training company in New York, they run they CFOs and CEOs, and they run these training sessions. So he was running a 1-day seminar on acquisitions directed at CFOs of serial acquirers. For lack of a better term, these are companies that do acquisitions every month. Okay, so it's like a book of the month club, an acquisition of the month club. And these guys are the CFOs of these companies. So he'd invited them to New York. He'd put them up at the Millennium, I think. And he was running a 1-day session. And he calls me and he said, would you be willing to come in and talk to the CFOs? And I said, are you sure you have the right person? Because everybody's pretty familiar with how much of a bias I have against acquisitions being your way to go. He says, no, I want you to come in. Because for the rest of the day, they're going to be listening to investment bankers. And we know what investment bankers think of acquisitions. It's the mother lode of all deal making. So if you ask an investment banker, do acquisitions make sense? The answer you're going to get is, of course they do. So he said, as kind of an antidote to the rest of the day, we'd like you to come in the last 30 minutes and talk about what you think about acquisitions. So I put a presentation together. I put the first slide up, and this isn't the first slide. And they kind of knew right away exactly where I was coming from. My biases were not hidden. I said, I'm going to tell you exactly where I'm coming from. I think acquisitions for most companies are a bad idea. They're the ultimate value destroyer. If you wanted to have top 10 value destroyers, acquisitions would be on top of the list. And of course, this didn't get me a very warm reception right off the top. So I said, let me back this up. Let's start off. I mean, too many times when we talk about acquisitions, we get into storytelling. We've got particular merger, particular acquisition. We talk about how nice the story was, right? But the real story in acquisitions, you look across all acquisitions. Let me start off with a chart that every time I look at makes me sick. This is a chart of, on average, what happens to the stock prices of acquiring companies and the stock prices of target companies. Let's start with a clear winner in this process. Stockholders in target companies, you see a big jump in the stock price on the announcement of the acquisition. There are a couple of interesting sub-stories. One is, see this big jump? That's on the acquisition date, the announcement date. See this run-up? What does it tell you? No matter what the SEC says about insider trading, news always leaks out. It's impossible to stop. There's just too much money involved. There's, in fact, a very slight drift in the stock price even after the announcement. That's usually a puzzle because you're saying, well, the news is out. How come they're still in effect? Because this other stuff still seems to come out after the acquisition. So that's what the target company will say. You look at the bidding company, it's very different, right? To the bidding company, nothing, 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 boom. It's not a huge drop, but many of these bidding companies are 10 times, 20 times, 30 times larger than the target company. On average, if you look at what happens to bidding companies, their stock price drops about 1, 1.5%, 2%, which might be deceptive because 1.5% of a $100 billion company could be far greater than the 4.5% that you're seeing on the target company. So on average, if you look at stock prices of target and acquiring companies, it's clear who the winners are and who at least the nominal losers. Now, when I of course showed this to company, one CFO puts up his hand and he says, well, this is very unfair. I said, what's unfair about it? I own the stocks. This is the fairest measure of exactly what's happening to me. He said, stockholders are short-term. A lot of applause, right? Oh, CFO, yes, short-term stockholders. Okay, fine. In the long term, these mergers work out. They don't see, they being the stockholders, don't see what we see. We get to look at cash flow projections. We get to see the inside of the company. We know things about these acquisitions that they don't know. They're reacting to the short term. We know what's going to happen in the long term. Let's look at long-term evidence. There are actually quite a few studies that have tracked acquisitions 5 years after to see if, in fact, these acquisitions deliver what they promise. McKinsey actually every decade does one of these studies where they take the previous 10 years, they look at all acquisitions in those 10 years, and they ask 2 questions about acquisitions. The first is, did the return on capital invested in acquisitions exceed the cost of capital? Is that an unfair question? When you make any capital budgeting project, what's the first question I ask you? Do you make more than your cost of capital? They say, just ask of acquisitions. Second question, did the acquisitions help the parent company do better than the peer group, right? So if you start off with a return equity of 7%, the rest of the sector was doing 8%, did the acquisitions help you become better? Half of all programs failed at least one test, and a quarter failed both tests. And this has happened consistently with every time McKinsey has looked at acquisition programs, it finds that result. Here's an even more damning statistic. KPMG, this was in the late 90s, did a study of almost 6,000 global acquisitions. It answered a very simple question. It says, it looked at the acquisition 3 years, 5 years after, and it asked, do the merged companies do better or worse than the competition? Is there any evidence of synergy in acquisitions? In 83% of all mergers, they found 0 or negative synergy. So this is 5 years after. So all this talk about synergy, at least look at the numbers, it doesn't seem to show up. And here's a final statistic. Half of all acquisitions are reversed within 10 years of the acquisition. In other words, you buy a company, and 6, 7 years later, say, we made a mistake, we unload the company, often at half the price you paid on the acquisition. So if your response to the first graph was it's short term, it doesn't capture the long term statistics are actually even more depressing than the short term statistics. Most mergers don't seem to work. Here's a scary thought though. The disease seems to be spreading. As you know, as many of you coming from emerging markets know, one of the big issues of pride in emerging markets now is if you looked at emerging markets, India, China, they used to be the targets of acquisitions. Many of these companies now are the acquirers rather than the targets. Tata Motors, for instance, acquired Jaguar. It's talking about, you look at companies in these markets that used to be targets and now acquiring companies. And in these countries, it's a huge source of pride that companies that used to be targets are now acquired. We're starting to see the first wave of evidence on whether these companies in India and China and Brazil are repeating the mistakes that developed market companies did. And you know what? It looks like they are. This is a study of what happened to Indian acquirers of companies overseas in the months around the announcement if you look at the cumulative abnormal return, you look at their price actually jumped from the announcement, but you track them through. By the time you go 20 months after so initially there seems to be enough of a rose on this decision that their stock price jumps up, but you track them 20 months after, their stock price is down almost 4% from the original acquisition. So it's very difficult to actually find a study that shows that collectively, in the aggregate, on average, that acquisitions pay off. So here's my summary. If I look at all the studies on acquisitions that I would conclude looking at the data. First is acquiring firms tend to pay too much rather than too little. You pay too much for a target company. They tend to overestimate those magic words, the value of synergy, the value of control. They seem to pay for things that they can't deliver. And they have a very difficult time delivering any of the things they talk about at the time of merger. You see, people make mistakes all the time. What's the big deal? First, these are big mistakes, right? And second, here's the depressing follow-up. There seems to be absolutely no learning built into this process. In other words, when you make mistakes, the next generation is always supposed to do better than the previous one, right? So given that we've had experience with 70 or 80 years of mergers, you'd think we'd be getting better at it. We don't seem to. Which is weird, given that we have all these smart people involved in M&A. You're saying, how come they're not learning? I think, personally, there's something structurally wrong with the way we do mergers that builds in this mistake generation after generation. So what I hope to examine in the next 26, 27 slides is what is it about acquisitions and the way they're valued and the way they're analyzed that leads to all these bad decisions. Okay. I'm going to start off with that basic fact that many acquisitions you overpay. Why do we overpay? Okay. I'm going to present you with what I think the 7 deadly sins are in acquisitions. Let's see if you can avoid all 7 of them and make it way to the other side. And that's what the test was about. Even if you did not try the test, you can do it in class. It's actually very simple. Most of the numbers you can work with in your head. I'm going to argue that these are the 7 things that drive acquisitions around the bend. The first is what I call risk transference. You're going to see in a minute what we mean by risk transfer, where the acquiring company starts to transmit or think that its risk can be transmitted to target company. I want to talk about subsidies. There's a lot of subsidization in acquisitions where the acquiring company's strengths are paying for target companies. We'll talk about subsidies. The third is there's a lot of autopilot, premiums and discounts. Control, for instance, classic numbers. 20% added on to your DCF value. Why? That's because you pay for control. We'll talk about where these numbers come from and why they might be dangerous. Synergy. What exactly is it? When does it show up? How do we evaluate? So I want to talk about synergy. Relative valuations, how they find their way into even intrinsic valuations, what place they show up in. A lot of valuations, in my view, people decide first and then look for a valuation afterwards. The problem with deciding first is everything's going to get driven by that bias. And finally, I want to talk about the fact that nobody seems to be held responsible for these big acquisitions. A lot of people pushing for them, then they seem to walk away. When they have mistakes, nobody seems to bear the consequences. Not the acquiring company's managers, not the investment bankers, not all those people who made the money in the process. There seems to be no clawback provision here when you make a big mistake. I'd like to know, or get a list, it's probably easy to do, of all those investment bankers who were involved in the Time Warner AOL merger. And then I'm going to ask a question. What are all these fees for? What exactly did this money get paid out for? So let's get the process on the road. I'd like you to be honest with yourself as we go through. So even if you don't say a word, do the test in your head. If you fail the test, say you failed. You might have a really good reason why you failed, so I'm going to let you rationalize away your failures. But here's the challenge I pose to you. If at the end of the process you have 2 or more failures here, and you have a job in M&A, I would strongly recommend that you reconsider. Okay? You can create an immense amount of damage in a really short time. Maybe you're in this for the destructive impulse, which is fine, right? So if you're here to destroy the capitalist system, you're in exactly the right place to do it. M&A is the place to go if you want to destroy corporate America, corporate Europe, corporate Asia at its core. Okay? You don't get too many chances in your life to make $50 billion mistakes. Here's one place you can do it. Okay? So you ready? Let's get started. As I said, most of these things you can do in your head, so even if you haven't done it during the weekend, let's get started. Let's assume that I come to you with a target company. This is what the numbers look like for the target companies. $100 million in revenues, operating expense of $80 million, operating income of $20 million, taxes of $8 million, after-tax operating income of $12 million. Let's assume the company will generate the same operating income each year forever. So there's zero growth. Cost of equity for the firm is 20%. The firm has no debt outstanding. What's the value of this? Let's do it step by step. What's your cost of capital? 20%, right? Because it's all equity funded. What's your free cash flow to the firm? We say, oh, it doesn't give me CapEx. Do I need to? What did I just tell you about growth? Zero. So what's the reinvestment rate? That goes with the zero growth rate. Zero reinvestment rate. So your free cash flow to the firm is going to be equal to your after-tax operating income, which is $12 million. You divide by 0.2, which is your cost of capital, because there's no growth. $60 million, right? So write that in. That's your value for the target company. We're going to build on that number. So I want that number to be nailed down. Everybody with me so far? Now let's play the advice game. I'm an acquiring company. My cost of equity is 10%. Now I'm a much safer company. The target company. Value this target company. Do you see the question I'm asking? Is the target company worth $60 million, which is what he came up with on the previous page, or is my company value $120 million? Come on, we've beaten this up so much that by now it should be automatic. Of course it's $60 million. You know how many M&A valuations the acquiring company's cost of equity is used to be? 50% of all acquisition valuations that I see, the acquiring company's cost of equity is used to justify the valuation of the target company. 50%. All kinds of reasons. We're big, they're small, it doesn't matter that much. What's the big deal? It's just a discount rate. It's not just a discount rate. And the reason for this principle is very simple, right? It goes back to what we said in capital budgeting. The cost of equity for a project should reflect the risk of the project, not the risk of the entity computing that, taking the project. You can be a safe company, but you cannot make risky companies safe just by acquiring them. Everybody with me so on this? We're unanimous, so none of you is ever going to be using an acquiring company's discount rate value target company. In fact, let's carry this as logical next step. Let's suppose you as the acquiring company decide to use your cost of equity and cost of capital to value every target company. Tell me what your future is going to look like. What are the companies that are going to look incredibly attractive? Every risky company is going to look cheap to you, right? You're going to buy risky company after risky company after risky company. In the process, what are you going to do to your own cost of equity over time? You're going to push it up, and 5 years later, you're going to be AT&T. This is exactly how AT&T destroyed itself during the 1990s. It started 1990 as an old-time phone company with really low cost of equity. It decided it wanted to become a technology company by acquiring other technology companies, which is fine, but it decided to use its cost of equity to value those technology companies. Not surprisingly, every technology company looked cheap to it and bought it, and 2 years later it write it off. Bought another company, write off another company. It was a process that almost devastated the value of the company because of what it did. Yeah. Still the same principle. In this case, as the acquiring company's cost of equity happens to be the target company's cost of equity. That's a different question. We'll talk about that. That's a different issue. That is an issue of how much debt can I use. That's going to be the next question. For the moment, though, we're talking about cost of equity. The cost of equity should always start with the unlevered base of the target company. How much you lever it will depend on the capital structure. Any questions? Yes. Did we? What did we do to get the total beta? We started with the unlevered beta of the private company still. What we adjusted for there was the fact that investors could be diversified or non-diversified, which can lead to different costs of equity. But we still start with the business risk of the private company. We just built in an additional premium for some investors being diversified and others not. And we had different investors bidding for the firm. It was the highest paying investor. The more diversified investor always won out. Second test. So let's suppose we pass, everybody say pass the first test. Look like you did. Nobody said no, so we passed the first. Let's move to the second test. Let's assume now that as an acquirer I have access to cheap debt. I have a AAA rated company. Debt costs me only 4%, and let's make that an after-tax cost of debt. And you plan to fund half of the acquisition with debt. Now tell me what the value of the target firm is. Same firm from 3 pages ago. What is the free cash flow again? It's 12 million, right? So the question I'm asking is, when I do the cost of capital for this firm, and forget about the levering, unlevering, let's leave the cost of equity at 20%. Let's assume half the capital comes from debt at 4%, and half the capital comes from equity at 20%. That'll give me a cost of capital of 12%. So can I increase the value of the target company to 100 million? Looks like I could, right? I am. In fact, if you look at it piece by piece, I am borrowing at 4%. I am funding half of the acquisition with debt. But are you comfortable with that, paying 100 million for the target company? Let's suppose you do pay 100 million. Why did your value go up in this case? What is it that about this structure that's giving you lower cost of capital? The fact that you have a AAA rating and can borrow at a really low rate, right? Why the heck are you paying the target company a subsidy? Because you've earned a AAA rating over the last 80 years. They had nothing to do with it, right? You spent 80 years building up your AAA rating. You have a really low cost of debt. You build it into their cost of capital. You will end up paying a premium to the target company's stockholders for something that they had absolutely no role in creating. You know how often, again, this happens in acquisitions? The acquiring company will take its low cost of debt, GE, for instance, plug it in. It used to be GE. Plug it in. Use a lot of debt, not because the target company, we'll come back and talk about when the target company can carry the risk. Use a lot of debt, not because the target company has debt capacity, but because the acquiring company has debt capacity. Plug it into a cost of capital, come up with this really low cost of capital, inflate the value of the target company and overpay for it when they had nothing to do with either the cheaper debt or the debt capacity. It is different if the target company is under level. We'll talk about that. If it could have carried 50% on its own and it chose not to borrow the money, then I have no problems with you using 50% as your debt ratio, but I would still not use the 4% cost of debt. I would use the cost of debt that the target company would have had if it went to a 50% debt ratio, and I guarantee you, it wouldn't have been 4%, it might have been 7, 8, 9%, but you've got to act like the target company would have done this on its own and come up with the cost of capital. That's the optimal cost of capital question you asked before that you could use to value this target company. Yes? So let's say you bought it, now it's a division of a company. Right. No, but even after it comes inside your company, it's still worth 60 million, right? I mean, you might artificially try to move the 40 million, but that 40 million is coming from the existing company. I mean, it's but why give that additional value to that division, right? In a sense, that had nothing to do with the division. So if you're allocating value, that's almost a capital structure value creation at the corporate level. I would actually keep it as a separate slice. This has nothing to do with the business level operating value of the company. But at that stage in the process, you have to decide how much each division will carry as debt on its own, right? So if you're doing a true valuation from the bottom up, some of the pieces valuation, you would actually have to take each piece and value it based on its capacity to carry debt. So if one division could carry 80% debt, the other could carry 10% debt, at least in theory you'd like those debt ratios to reflect what the division can carry rather than taking the company's debt ratio and splitting it across the board. So even though you might be retiring that and claiming that as a benefit, it's really not a benefit that accrues to the target company. But, I mean, in a sense, you're saying after I buy it, it's just cosmetic. You're right. There it might become more of a cosmetic decision, and I have less of an issue with it as long as you make the first decision. Any questions? Yes, sir. Fair value as opposed to what? Right. It's still worth 60. So we're still stuck at 60. We haven't moved yet. If it could get leverage, here's the difference. You would use let's say their optimal debt ratio is 50%. I'd use the 50%, but I would use the cost of debt they would have had at that. So that's the difference. And But that is going to be part of this control premium we're talking about. That's why I want to keep this separate. For the moment, I'm going to act like they don't have the debt capacity and ask that question. But we'll come back and ask, what if they did have debt capacity? Any questions on the second test? Yes, please. Let's hold off on that because you're talking about changes in the value of the company coming from changing who's running the company. Let's think about that as a control. So we'll talk about controls separately because that's really not a capital structure issue as you're basically, remember the odds of survival, the truncating value, you're saying what if I could remove that? That could increase the value of the company. We'll ask what's the value of doing that? And second, we'll have to ask should we be paying that as a premium, right? They're two separate questions. You might be able to increase the value, but should you be paying that as a premium to the target company stockholders is open for debate. You're the one actually doing the work, right? By saving the company, why give away all the premium to the target company stockholders? So perfect segue into the next issue. So you come up with still stuck at 60, right? I said, oh no, but I want this number to go up. I said, oh, why about that 20% premium? You know where the 20% control premium that gets used almost by rote in M&A departments comes from? It comes from this data service called MergerStat. MergerStat is a data service that collects data on every acquisition. It's a great database. The 20% is the average premium paid by acquiring companies over and above the market price of target companies. So that's the rationale MergerStat uses. On typically, acquiring companies pay 20% more than the stock price to get a target company. They're getting control of the company. Let's call it a control premium. Okay, so take the 60, add 20%, that'll bring me to 72 million. Let me break up that question to two subparts, and you're going to see very quickly why the 12 million that I've added on, the 20% of 60, might be too low in one case and too high in another. To me, the value of control, and we'll come back and talk about this on Wednesday, value of control comes from the fact that you think you can run a company better than the existing management, right? That's in the essence of value of control. Let's assume in this case you look at the target firm and you say, look, if I ran that target firm, that 20% margin you saw, the $12 million that you saw in after-tax operating income on the 60 million, if I ran this firm, the margin would really be 30%. And if you want, you can add on, if I ran the firm, the optimal debt ratio would be 30% of cost of capital. So in other words, you feel that you run the firm, if you ran this firm, it would make much more in operating income. What's going to happen to the value of this firm if all I did was change the operating margin from 20% to 30%? 12 million will become 18 million. 60 million in value will become 90 million. In which case, what's the value of control? 60 million is the old value. You just added 30 million. That's a 50% control premium, right? Which I thought was too high. So let's change the facts a little bit. Let's suppose the target firm is already perfectly run. How much should you pay as a control premium? What are you paying a premium for? You're controlling the firm. You can't change a thing. So my argument is a fixed control premium makes zero sense because it can't be the same for every firm. If you are taking over a badly managed, badly run firm, the control premium can be very large. If you're taking over a well-managed, well-run firm, the control premium can be much smaller. So how would I quantify it? Do two valuations. Status quo value with the existing management, value with you running it. The difference is the value of control. On Wednesday, we'll actually talk about making this explicit for companies, but that's actually what the control premium should be. So when we think about these control premiums and we see people using them, stop and say, where's that 20% coming from? Why are we paying 20%? What are we going to do? Well, we're getting control. Control by itself is worth nothing unless I can increase the cash flows. Show me something substantial before I pay a premium. Don't just tell me because everybody else is paying 20% and I'm getting control of this company that I should pay a premium just for control. Yes? I think that's actually Alpha's point is very good, which is once you come up with a value of control of 30 million, then your bargaining starts, right? You're the acquiring company, I'm the target company. What are you going to start off your bidding at? 60, right? Hope that I sell. But here's what's going to determine whether you're going to be able to succeed. If you're the only one who can improve my margins, then you're in a position of strength, right? Because I'll walk away. But what if I'm such an incompetent manager? I look around and say, you know what? Anybody else running this firm would do much better than I did. then your position becomes much weaker because I'm going to play you off against the next. So I agree with you. You want to keep at least a portion of that value. Odds are not 100% that 30 million is going to end up with you, but how much will end up will depend on how much power, how much exclusivity you have in delivering that improvement in margin. So any questions on control? So at this stage, where are we? We have 60. If it was badly run, we'd be pushing up to 90. If it was well run, we're still stuck at 60, right? Then I hit you with the magic word, synergy. Let's talk about synergy. In fact, let me give you a couple of scenarios here, and then we'll try to flesh it out. Assume that the argument being made is that the combined firm will be less risky than the two individual firms. We made this argument, right, with options? When you combine two firms in different businesses, they're less risky. And therefore, because they're less risky, they should have a lower cost of capital. Is that argument okay? Does it make sense? When we did the option pricing, what were we talking about when we talked about risk? We're talking about the variance of firm A, variance of firm B, combining the two firms. Because they're not perfectly correlated, the variance of combined firm will be lower than the variance of the two firms, right? Why wouldn't that automatically translate into a lower cost of capital? What goes into cost of capital? You've got a cost of equity and a cost of debt. What drives the cost of equity? If you're looking at publicly traded firms, you're looking at only the portion of the risk that is not diversified. If you're doing cost of capital the conventional way, there can be no savings in the cost of capital by combining two firms and saying they're safer because the betas reflect the risk that couldn't have been diversified away in the first place. So if people are arguing that in a merger the prime motivation is a lower cost of capital, I'm very skeptical. It's not in the denominator. You're going to see its synergy value. It's going to be in the numerator. So let's talk about the more realistic scenario for synergy. There are potential growth and cost savings. Could there be potential growth and cost savings? Let's ask the generic question. Can you combine two firms and potentially get growth? Sure, right? Synergy in paper is easy. We still have to come up with a value, but you can come up. In fact, I'll take you through a couple of very specific examples, or I'll throw in the synergy and you can value it. Now I'll ask the follow-up question. Let's say you value the synergy. And this goes back to the same question you asked about control. So let's say you value the synergy at 50 million. Should you pay that as a premium on top of the 60? If you pay it as a premium, what have you done effectively? The target company stockholders get 100% of the premium. What do I get as the acquiring company? If you're going to put in the work of doing an acquisition and trying to deliver the synergy, you should try to at least bargain for a portion of that synergy. And if you look at practice, even in cases where there's synergy, 110% of the synergy seems to go to the target company stockholders, minus 10% ends up with the acquiring company stockholders. So let's take synergy apart. Okay? What's the definition of synergy? Don't give me that 2 plus 2 is equal to 5 crap. It's one of the most useless definitions I've ever seen. Not to mention mathematically it's impossible. But it's a definition given by sloppy people who really don't want to think through what synergy is. The essence of synergy is you bring in two entities, and the combined entity is able to do something that the two entities could not have on their own, right? Think about that definition, and then take a look at the next merger that gets described and what they talk about as synergy. It's amazing how many items that get described as synergy don't pass that test. I'll give you one example. When Disney bought Cap Cities, here was one of the synergies they talked about. They said by buying Cap Cities, they would have a place on Saturday morning to show Disney cartoons. You're paying $18.5 billion to a place on Saturday morning to show Disney cartoons? I mean, could you approach ABC and just buy the half hour? I mean, it's so much cheaper. You don't need an acquisition to pull this off. That's not synergy. That's something that could have happened anyway. So here's how I'm going to approach valuing synergy. I'm going to take it very pragmatically. I'm going to think about it from the perspective of doing evaluation. It has to show up somewhere in the numbers, right? So I'm going to look at where in the numbers different kinds of synergy are going to show up. Let's start with operating synergy. We'll come back and talk about the other kind of synergy, which is financial synergy. Operating synergy can show up in one of two places. It can show up as economies of scale, or it can show up as strategic advantages. Let's take the easy one first. Economies of scale. You have two steel companies coming together, ArcelorMittal. Two banks coming together. The biggest synergy is going to be in terms of cost saving. That by combining these two companies, you're now able to save on some costs. All the synergies, this is the easiest one to value. You know why? You have cost savings, you specify what they are, I take those costs out of the company. I have a higher operating. I'm done. Now everything else takes care of itself. So it shows up as higher margins, higher profits, existing revenue. I'm done. The other type of operating synergy is messier to that. These are strategic advantages, growth synergies. Because they can show up in one of three ways. You might be able to earn higher returns on your new investments as a combined company than you were able to earn as individual companies. In which case, your return on capital goes up, increases your growth, increases your value. You might be able to take more new investments. Your return on capital stays where it is, but you might be able to take more projects as a combined company than you were able to as individual companies. In which case, what changes? Your reinvestment rate changes, same return on capital, higher growth, higher value. Or, this is the trickiest one, neither your return on capital nor your reinvestment rate changed, but because you're a combined company, you have stronger competitive advantages against the rest of the sector than you used to. And the way it manifests itself is you grow for a longer time period. Remember we talked about the length of growth and DCF valuation being a function of your competitive advantage. You were able to grow 10 years rather than 5 with that same return on capital reinvestment rate, which increases your value. Much more difficult to value, but you can see exactly where you're going to be going. When you talk about growth synergy, I'm looking at the return on capital, the reinvestment rate, and the length of the growth period. So that's my strategic advantage. Kevin? It could be economies of scope. It could be new markets. It could be new products. Maybe as a combined company, you are able to do things, introduce products that you couldn't have as individual companies. So it's any of those things that generally when people talk about expansive synergies, they're talking about growth synergies. Right? Cost synergies are kind of restricted. Growth synergies, you can talk about dreams and hopes and all these markets you're going to conquer, and I'm trying to put a number on it. And you know what? Managers are incredibly slippery when it comes to synergy. You never want to give specifics, because then you can put a number on it. They want to talk about synergy in kind of broad sense. Say, I can't put a number. It's too qualitative. Well, you just paid $5 billion for it. If you're going to pay money for it, don't give me this. It's too qualitative. I can't put a number on it response. It doesn't make any sense. If you're going to pay for it, you have an obligation to try to at least get an estimate of what it's going to deliver in terms of cash flows. And then we can see whether $5 billion is too much or too little. So here's what I'm going to do. Let's talk about setting up a way to value synergy. To value synergy, here's what you need to do. First, you need to value the target company and the acquiring company standing independently. Here's one of the first signs that people are not valuing synergy. If you see a target company valuation, that's all you see, and the analyst says the synergy is already built in there, it couldn't be. Because by definition, what is synergy accrued to? It goes to the combined company. So to value synergy, you've got to value the target company, you've got to value the acquiring company. How many M&A valuations do you see where people even value the acquiring company and they talk about synergy? How can you have synergy valuation for the acquiring companies not brought into the picture? So first step in the process, you get two companies as independent companies, standing alone. Then combine the company. If you have no synergy, you know what the value of the combined company is going to be? Present values are additive. The value of the combined company will just be the value of the target company, the value of the acquiring company. You're done. Then throw in everything but the kitchen sink into the combined company. So basically, you tell me what the synergies are. I'm going to go put it into the numbers in the combined company. Assuming that there is real synergy there, the value of the combined company with these synergies built in will be far greater than the value of the two companies independently. That difference is the value of synergy. Okay? So let's try this out. Let's start off by first dispensing with that illusion about risk going down. Right? The reason I think this illusion even exists is people think in terms of total risk, entire variance. If you're using a beta to get your cost of equity and your cost of capital, there should be no value savings by combining two companies. In fact, if you go look at my book, I actually have a proof of this. You take two companies, you combine them, you take the beta then of the combined company will be a weighted average of the betas of the two companies, you work the numbers through, your value should not change 1 cent. But here's the one exception to the rule. You have two private companies coming together. Could there be an increase in value? We said for two publicly traded companies, there cannot be a reduction in the cost of capital. When you have two private companies coming together, do you see a benefit to the merger? Two private companies come together because with private companies, we said total betas matter. The cost of equity is high. The owners are not diversified. Two private companies coming together, you could potentially get a benefit because the total risk comes down and their total risk matters. This is part of the reason I said, if you look at family companies that grew in Asia and Latin America prior to the days public markets got there, and you look at what businesses they're in everything. They diversified into every business because the benefits to become a conglomerate, if you're a private company, are great because your correlation with the market goes up, your total beta decreases. So that's the only exception to the rule, that the cost of capital can't change. If you have two private companies, that could in fact happen. You could have a lower cost of capital for that combined company. Yes? Right. That's, you know how I deal with it? I value the synergy first, and then I'd subtract out the cost of doing the merger, because it's not just the acquisition cost. I have to bring in fees, the transactions cost, because my value of synergy has to be greater than my cumulative cost from doing the merger, right? But it's tough to bring it into a valuation, especially with the one-time cost. You throw off all your numbers. If you throw it in the operating income this year, so it's best when you do the first valuation to act like there's no merger at all. Value the companies as is. Then when you do the combined company, you can throw in everything that happens as a consequence of the merger into that combined company's valuation. Because there are accounting issues too, right? You might be allowed to write up your assets, your depreciation might go up. When you do the combined company valuation, you get the benefit of throwing everything that you might worry about into that valuation. That's the second example. Remember the Procter & Gamble and Gillette merger? It was about two of the largest consumer product companies in the U.S. coming together. At the time of that merger, I decided to do a best case valuation of synergy. In a minute, you're going to see why I'm going to call it my best case valuation. Okay? So this is the time of the merger. There's a lot of talk about why the merger was going through. So I said, okay, let's value synergy at the time of the merger. So first I value Procter & Gamble and Gillette standing alone, and you can see the value that I got for the equity, $221.2 billion for Procter & Gamble, $59.9 billion for Gillette. That's as standalone companies with the companies as they were before the merger. If there was zero synergy in this merger, the combined company that I've called Piglet, Procter & Gamble plus Gillette, the value of the combined company would be $281.1 billion. Then I opened the newspaper and I read everything Procter & Gamble managers told me they were planning to do on this merger. That's part of the reason it's best case. I've taken you at your word as managers. First, Procter & Gamble managers said that there was a lot of overlap in advertising and they were going to cut advertising expenses. I think Procter & Gamble is one of the largest advertisers in the country, perhaps the largest one, and Gillette might be the sixth largest. They talked about combining the two and reducing costs by $250 million. Now, I assume they meant what they said, that they would happen instantaneously. So I dropped the operating expenses by $250 million, which feeds into higher operating income, higher return on capital, higher value. They also talked about a slightly higher growth rate. They can't increase their growth rate exponentially because they're such large companies that even small changes in the growth are tough to pull off. They talked about how they could use the Gillette brand better than Gillette had used it historically. So I said, okay, I trust you. And I used a higher growth rate. With those two changes put in, the value that I got for the combined company is $298 billion. Seems like be very careful. When you take these big companies, even small changes can translate into big effects in value. See that difference between the 298 and the 281? That's my best case valuation of synergy. Let's go from this down, because in a sense, this is your best case valuation. Everything that happens beyond this is going to be a disappointing thing. Many companies that claim to cut costs never fully carry through. So they talk about cutting costs by $250 million. I wouldn't be surprised if they actually ended up cutting only $150 million. It's easy to talk about cutting costs, much more difficult to pull off. If I made that $250 million to $150 million, my $17 billion becomes about $10 billion. So I lose about $7 billion in synergy if you say only $150 million. But here's the thing that worries me the most. Assume you have two companies that come together in a merger. And let's say you believe that there's going to be synergy. These are two large companies coming together. Is synergy going to show up the day after the merger? Have you ever been in a large company the day after the merger? What does it feel like relative to the day before? It feels like nothing's changed, same company, everything seems... I'll give you an example of how long it actually takes for these cost savings to manifest themselves. I've taught at Citi now for about 18 years. This might be the first year I don't, for reasons out of my control. Okay? Reasons in their control, actually. And I used to teach for Travelers for a while, and I used to teach at Solomon. for a while, as when they were independent companies. As all of those of you know your history, what happened was Citi first bought Solomon, then Citi Solomon bought Travelers. They all became one company. This happened over a period of maybe 8 years. So 98, after the Citi Travelers merger, I was getting a little tired of doing these sequential sessions at the three places. So I called the training person I knew at Citi and said, "You're now one company, right?" And she said, "Yes." And I said, "This year, why don't we just do one training program for the Citi, the Solomon, and the Travelers group? That way I can do all three in one go and walk away." She said, "We can't do that." And I said, "What do you mean you can't do that?" "Well, see, the Solomon people don't mix with the Citi people. And the Citi people don't think that much about the Travelers people, so we can't put them all in the same room. We can't do it this year." 5 years later, I was still dealing with 3 separate training groups in 3 separate companies. I know this is a very small slice, but if this is happening in place, because when they did the merger, one of the things they talked about was the cost cutting, how they were going to consolidate things. If this is happening in their training, I hate to think what's happening in all of their other functions where they claim to be cutting costs. So even if there is synergy, it takes a long time for synergy to show up, right? So let's take this example. Let's assume that 17.185 billion was a reasonable estimate. But let's now add another assumption, that it'll take you 5 years before you actually see the synergy show up. How would I bring that into my valuation system? What am I going to do? Discount it back. Now the tough question. At what discount rate? Let's look at the choices. I can use the cost of equity of the target firm, cost of equity of the acquiring firm, cost of capital of the target firm, cost of capital of the acquiring firm, cost of equity of the combined firm, cost of capital of the combined firm. This is a plethora of riches I face here. So which of those discount rates is the right discount rate to apply? Cost of capital what? Of the combined firm. Why? That is in fact the right answer. Why? Why cost of capital rather than cost of equity? The entire firm. So if it had been just synergy to equity, then synergy to the entire firm, it's going to be cost of capital. Why to the combined firm? Because the synergy shows up to the combined firm. The acquiring firm doesn't get the synergy. The target firm doesn't get the synergy. It's the combined firm. It's the cost of capital of the combined firm. In this case, we apply the cost of capital of the combined firm to the 17 billion. You discount it back 5 years. That's all you need to do. No need for any pyrotechnics here. The present value you get is about 12 billion. 17 billion becomes worth only 12 billion if you wait 5 years. But here's the final number, and this is a number that should be shocking. You know what Procter & Gamble actually paid as a premium on this merger? $24 billion. Best case valuation is 17 billion. You pay $7 billion more than your best case valuation. How the heck do you hope to walk away from this merger hoping to create value for your shareholders? I think the reason I'm a little cynical about M&A classes, we spend so much time talking about fit. Is this the right target company? I'll tell you, at the wrong price, there is no good fit. At the right price, I can find anything to fit. I think there's too much talk about strategic imperatives, does it fit, and too little talk about the price you're paying on a merger, because ultimately, if you pay too much, you cannot be redeemed. There is no way to make that money back. Okay? Any questions? So let's take a third example of synergy. Let's take a tax benefit. Let's assume that you look, this is from way back, so the company some of them are defunct now. Best Buy. Right? They're thinking about buying Zenith, a company that used to have a valuable brand name but has nothing else. But they do have one valuable asset. You know what the most valuable asset is? They've lost a lot of money for a lot of time. They have a $2 billion net operating loss. So here's my first question to you. If you're Best Buy, you're acquiring Zenith, and the only reason you're acquiring it is for the net operating loss, first, don't ever mention this to the IRS. It is illegal. An acquisition driven purely for tax saving is they can challenge it and get it stopped. So, but let's assume that you don't mention it to anybody. Secretly, you decide that this is the reason why. So you're buying Zenith because of the $2 billion net operating loss. Your tax rate is 36%. What's the benefit of such net operating loss? Seems trivial, but help me out. Seems like 36% of 2 billion is 720 million, but that's built on two assumptions. First, it assumes you have $2 billion in operating income right away, right, that you can claim the loss again. And second, it assumes the IRS will not challenge you and delay the payment. So assuming you can get the tax benefit immediately, you have enough operating income, the tax savings is just going to be the tax rate times the NOI. So that's 720 million. Let's make it a little messier. Let's assume that Best Buy is only $500 million in operating income. And expect that to be the operating income for the next 4 years. Now how would I compute the tax rate, the value of this net operating income? So I'm getting 720 now. What am I going to get? 180 each year for the next 4 years, which is now going to create a problem for me because I have to discount them back. Now let me ask you the same question I asked you a couple of minutes ago. What discount rate should I apply? You know how often I get an email question about this specific issue. I'm doing a company with NOLs. I have these net operating. What discount rate should we apply on it? Because I've seen every conceivable variation. I've seen the cost of debt used. I've seen the cost of equity used. I've used the cost of capital used. Acquiring company, target company, every possible combination being used to discount this, and it can make a huge difference. How do I decide which discount rate? In general, how do we decide what discount rate to use on any cash flow? What do we look at? We ask, how risky is this cash flow, right? So let's frame this question differently. What is the biggest risk that you will not be able to get this net operating loss? The loss is given, right? So there's no uncertainty about the loss. So Zenith is off the bat now. The only number that we're uncertain about is what in this case, since we're using operating income, but if you want to do net income, it'll be the variation in whatever bottom line number. If you're doing a firm valuation, it's going to be operating income. If you're doing an equity valuation, it'll be net income. That's the risk that's driving the risk of this tax benefit, which means if you're doing a firm valuation, the discount rate that's going to discount this net operating loss back is going to be the cost of capital because it's going to be the operating income variation. The discount rate, if you're doing an equity valuation, will end up being the cost of equity because then you're looking at net income. But let that be a guide. When you get stuck on coming up with a discount rate, step back and ask, where is the risk coming from? What am I worried about? Because that's going to give you an answer to what discount rate to apply. In fact, we used a variation of this argument last week when we had the licensing fee, where Biogen had licensed out its products, like 2 sessions ago maybe. Licensed out its products to, and there we used the pre-tax cost of it. It's exactly the same rule. Look at the risk of the underlying cash flow. That should give you a sense of what discount rate to apply. Now let me ask you a final question. So the value that let's say you take the present value of 180 million every year for the next 4 years at the cost of capital of Best Buy, because there is really no Zenith, it's a shell. You come up with, let's say, 620 million. The market price of the stock is 800 million. It's the stock price and its number of shares. Should you add the 620 million on top of it? Should you pay what you've estimated as a value of synergy as a premium on the market price? Yeah. Let's say the 100% probability the IRS will let you go. I've taken that up because zero. Before you say yes, ask yourself what's going into that market price. Why were people pricing on Zenith at 8? It says nothing going for it, right? Only thing it has going for it is what? The $2 billion net operating loss. Did people know about the loss? Of course they did. It's right in the financial statements. You see what the danger here is? If the market is already building in the expectation that this is your big asset, you're going to get 500, 550, 600, that stock price you see today already reflects that. If you add 620 million on top of this, you might end up double paying for the same benefit. It's one of the most dangerous things of market price plus. Because a lot of people say, I'm not going to bother doing a valuation because there's a market price already. I can add the synergy value on top of that market price. If you do that, you're mixing up apples and oranges because you haven't valued the market price. You have no idea what's already built in there. Yeah. Exactly. You estimate an intrinsic value that's different because then you're building off scratch. You know exactly. My point is you don't know what the market is building in. You don't know what the market is building out. If you add premiums on top of that, you have no idea what you double counted and what you triple counted. Okay? But very common again, acquisition, starting with market price building up, and that's, it's going to get you into trouble if people value synergy. Last example of synergy. In the late 70s, you started to see the first LBOs. Okay? And the first LBOs were actually very well structured. They didn't have a huge amount of debt, so they used leverage, but not 90% debt. They were like 50% debt. But they also took advantage of a loophole that existed in the tax law then. And this is a very short period, but you know how, you ever see these tax reform acts that come out of Congress? They're like 1,600 pages, and I'm sure nobody who actually votes on this has actually read it, including the people on the tax committee. And what often happens is in the last moment, aides to the congressman can slip in things in there, and nobody even knows who put it in there. So they say, I don't know, I didn't put it in there. It's 1,600 pages, who can know, right? And there was a Tax Reform Act where somehow a clause got put in, and this was a brief period, where if you did an acquisition, you were allowed to write up the book values of the target company's assets to whatever you paid as the total premium on the acquisition. So you could basically have no goodwill, and every can you imagine what an incredible advantage I've given you? Because basically if everything gets written up to what you paid, when you do depreciation from that day on, you could be getting 3, 4, 5 times the depreciation you used to just 2 days ago. One of the reasons, you heard of Congolium, right? This is a company that makes this kitchen flooring. Like, you know, so it's a company that's been around a while. That was targeted for a leveraged buyout. They spent $400 million in the LBO. One of the reasons they targeted was this potential to write up the assets. So I'm going to focus on just that depreciation tax benefit, and let's see how much value that added in this acquisition. Here's the depreciation they would have had if they hadn't done the LBO. So that's a pre-LBO price. Here's the depreciation they were able to claim post-LBO by writing up the values of the assets. The change in the depreciation is what's going to give them the tax benefit. I took the change in the depreciation multiplied by the tax rate, which was the 48% for this particular LBO. The present value of those tax savings over the next 10 years, discounted back at the cost of capital, is 41.76. Doesn't sound like much, but the total deal was worth $400 million. More than 10% of the value in this deal just came from taking those assets and writing them off. In fact, let me go back to the page because I didn't get to the financial synergy part. When we talk about tax benefits, it could be the money-losing firm, it could be the writing up of assets, and in some countries, the tax laws actually encourage you to do acquisitions because they give you additional tax benefits. I'll give you two countries where acquisitions benefit you as an acquirer. Right? One is Brazil. You know why acquisitions help you in Brazil? We talked a little bit about this when we did the price-to-book ratio. We talked about why Brazilian companies have high book equity. What was the reason? They're allowed to claim a tax deduction based on what they call interest on capital, which is 12% of your book equity. In Brazil, if you do an acquisition and you can make your book equity much higher, you actually get a tax savings afterwards because you have a much bigger book equity on which to claim the tax savings. On the Ambev, when Ambev was acquired, this was about 5 years ago, it was estimated that 30% of the premium in that merger came from just being able to have that additional interest in capital, which means taxpayers were effectively subsidizing this merger to 30% of the additional premium. That's one country. The other is Spain. Spain is the odd man out in Europe because it's the only country where you're allowed to claim the amortization of goodwill as a tax deduction. It drives the rest of the EU crazy because it gives Spanish companies a decided advantage in an acquisition. I mean, can you imagine Time Warner, how much NOLs they could have now if they'd been allowed to take that goodwill they had on the AOL merger and claim it as a tax deduction? So in some countries, tax savings can feed into acquisitions, add to their value by changing your tax base, by allowing you to save in taxes in the case. We talked about debt capacity, right? We talked about diversification, at least for private businesses. The one thing that I did not talk about is in some cases it's possible that you could have two companies that standing by themselves can't borrow money. It's not that they don't want to, but they can't. Their optimal debt ratio is 10%, but you combine the two companies, because they become larger and more predictable, less variable, their optimal debt ratio might creep up from 10 to 20%, which means that's one of the few cases where you can actually have a cost of capital decrease after the merger, not because the betas have gone down, but because you have more debt capacity, you take full use of it. So those are all examples of synergy. I'm not saying synergy does not have value, just don't double count it, don't add extra premiums when none is discussed. Yeah. That's not true. Why does depreciation matter? Depreciation creates a tax benefit. You subtract depreciation, you add back depreciation. It's not a neutral effect, right? You subtract depreciation, you actually lower your taxes, right? What is expected intrinsic value, right? Think of a company with a zero depreciation, a company with $1 billion in depreciation. The company with $1 billion in depreciation will have $400 million more in cash flows every year. It's a tax. If you have no taxes, depreciation doesn't matter. But with taxes, depreciation creates a cash flow effect, which in turn affects your valuation. So the key lesson in synergy is don't just pay for synergy because it sounds good. Put a number on it, see how much it's worth, then ask yourself, you want to bargain for a portion of that number. So think about what a realistic estimate is and see what you can get to. Yes? As long as you can get it cheaper than the market is valuing it at, that's all. Market value is everything, right? Market value is growth, market value is return on capital. Markets have values for every number that you have in it. It's not just synergy. Everything that you're doing in intrinsic value, the market is a value for. Your objective is to get the company for less than that intrinsic value. So the market price is less than the intrinsic value. So you do the intrinsic value. If you're doing a bottom-up intrinsic valuation of Zenith, you do the intrinsic value of their operating assets, add the $620 million, whatever you got as the present value of the tax benefits. If that's greater than 800, you'd buy the company. If not, you'd walk away. So market price becomes what you have to pay for it. So it's what you compare your intrinsic valuation. So it does matter ultimately whether you do the transaction. Any other questions? Yes. Well, Yahoo was the one that got punished. Microsoft wasn't the one that got punished. Well, the question is whether that was a result of the Yahoo failure. I'm not sure. The implication there was if they'd bought Yahoo, the stock price would have bounced up. I don't think so. In fact, the best thing that probably happened to Microsoft is that they walked away. 2 months later was so in a sense, when we're not talking about 10 years later, it very quickly, there might be that short term, you try to do something, you're so incompetent, you can't even do an acquisition kind of response. And then people say, well, anybody can do an acquisition. All you have to do is offer a higher price, right? What dummy can't do that? 20, 30, 35, 40. To me, the essence of a company is to know when to walk away. And if you look at companies that have walked away from acquisitions, 95% of those companies, you ask them, are you happy with what you did? They say, the best decision we ever made was to walk away from that acquisition. Boston Scientific, Johnson & Johnson. You look at company after company. So there might be that short-term disappointment, but it doesn't even have to be long-term. It's just a week later. Because what happens is you get a bunch of, I don't even know what to call leeches who show up at the time of an acquisition. The risk arbitrageurs, the people who play games, they're obviously disappointed the game is over. But the last thing you want is those guys in your company anyway, right? Let them sell and move on. Let somebody else come in who's fresh and long-term and thinks about your company. So there might have been that short-term disappointment. I don't think Microsoft today, if you ask them, are you disappointed, Chelsea, was investing in the day? Let's talk about the last couple of things. So let's say at this stage, I'm getting desperate, right? I'm still stuck at 60. So I'm trying to push the value up because that's the only way I can do it. I say, you know what? I've taken another look at the numbers, and it looks like other acquirers are paying 5 times operating income. Remember, this company's operating income is $20 million. The after-tax was $12 million. Pre-tax was 5 times 20 is $100 million. Initially, you're a little reluctant because you say, well, I'm doing a discounted cash flow. I said, no, I'm just doing the terminal value based on that. Let's call it an exit multiple. You know why people call it exit multiple? You hope to sell it to somebody else at $100 million more. It's somebody else's problem. And of icing on the cake, this is going to be an accretive acquisition. You know what an accretive acquisition is? What's the definition of accretive acquisition? The earnings per share of your company will go up after the acquisition. So what I'm saying is you can pay $100 million, everybody else is paying it, and by doing it, your earnings per share will go up. That's a good thing, right? This is, I think, a can of worms. Let's take it piece by piece. Let's take this first set. I got this 5 times EBIT by looking at whom? Other acquirers, right? Talk about bias samples. If you're doing a relative valuation, at least have an unbiased sample. If you pick a group of companies and you look at essentially other acquirers, you know you've already found a group of companies where people are far more likely to overpay than underpay, right? You know the history. Never ever do an acquisition valuation doing a transaction multiple. Transaction multiples are deadly. I see them used all the time. Transaction multiples are the most dangerous way to value companies because they're effectively looking at a subset of companies where people are more likely to overpay than underpay. But if you take an M&A class, think of how many transaction multiples you've seen, right? Again, if you're an investment bank, you can see why they like it. No transaction, look, everybody else overpaid. Why shouldn't we? So it's a case of bias sampling. If you're going to do relative valuation, at least look at the entire sample. Look at what other chemical companies are trading at, not just what other chemical companies were acquired, but acquired. So when you talk about the value of a target company, don't let it be driven because everybody else is doing it. Here's the other argument I've heard. If you don't do this acquisition, somebody else will. And in this sector, everybody's doing acquisitions, so you have to be part of the acquisition process. Nothing of lemmings driving the process. What do you think of this accretion dilution? A lot of M&A deals. It's amazing how much time gets spent working out the earnings per share number to show that it's accretive. Let me ask you a question. What type? Let's say you look at two companies without even knowing what the two companies do. What has to be true for an acquisition to be accretive? But let's talk specific. PE ratios of the two companies. What's got to be true about the PE ratios of the two companies for earnings per share to be accretive? You're the acquiring company, the target company. Right? Whose PE ratio has to be high? Whose PE ratio has to be low for an acquisition to be accretive? The acquiring company's PE ratio has to be high. The target company's PE ratio has to be low, right? Because basically the way you compute the earnings per share afterwards is you take the combined earnings and divide by the number of shares. So if you're telling me that accretive acquisitions are good, what have you just told me? Anytime you buy a company with a PE ratio lower than yours, it's a good merger. Anytime you buy a company with a PE ratio higher than yours, it's a bad merger. What kind of rule is that? That's one of the stupidest rules I've ever heard. So if you're a company, let's say your PE ratio is 100, you buy another company with a PE ratio of 80, you're okay because your earnings per share went up after the transaction. You know what the hidden reason behind this is? What are they implicitly assuming about your PE ratio of the combined company after the merger? That will stay at where it is today. You're at 20 times earnings today. You buy this company that is trading at 8 times earnings, that your PE ratio after the merger will magically stay at 20 as if the market is stupid. I mean, why did the company that you just bought have a low PE ratio? There's low growth, a high risk. You're buying all of that stuff. Why would you still end up with a 20 times earnings? So when you see these accretive dilutive analysis, you might be the target of somebody saying, look, the acquisition is accretive. Ask them to take the slide down. So you don't care about accretion. Accretion should not be a variable that you even think about in a merger. It has nothing to do with whether an acquisition is well priced or badly priced because it tells you nothing about the price. Now let's come to what really is going to push you over the edge. So at this stage in the process, you're still stuck at 60. Looks like you can't pull the deal off at 60. So what I think should be the tipping point. The CEO really, really, really wants to do this deal. You see, that can't be a factor in a deal. You'd be amazed at how many deals I think get done because the CEO gets his mindset that he wants to do this deal. I might have mentioned this earlier in my corporate finance class, but there was actually a study that was done about 8 or 9 years ago by researchers at Columbia. What he did was he looked at the premiums paid on acquisitions, and he tried to figure out what factors explain why premiums were high on some acquisitions and low on others. So he tried different things, growth and cash flows and risk. You know the variable we found was most critical in explaining the size of the premium? The ego of the acquiring company CEO. So how the heck did they measure ego? You know how they did? They went to LexisNexis and they typed in the name of each CEO. And the more mentioned, if you've been in LexisNexis, this is like this data set with everything in it. The more mentions they found of your name, the bigger the ego they assumed you had. So Michael Eisner, 68,000 mentions, huge ego, big premiums, amazing how much it explains. There's another study that found that acquisitions magically move CEOs towards wherever their vacation home was. I'm not kidding. Aspen, that's my next company to target. You know why? Because my vacation home is in Aspen. This will allow me to kind of stay around in Aspen a little longer. Don't underestimate how much of this is driven by managerial incentives and how little of this has to do with economics. We spend too much time trying to rationalize in the economic business. Why would they do it? When in fact the true answer might be in what's in the CEO's head. So a lot of egos in this process, a lot of people pushing for the deal. Let's face it, there's a lot of money on this deal, and once a deal gets started, it's very difficult to get in the way. You feel like a skunk at the party. I mean, everybody else wants the party to continue, but somebody's got to be slowing the process down, saying, but it's amazing. You get through, it has a mind of its own. I still remember what Bruce Wasserstein said when he was asked why he paid $70 for Federated. Remember, this is a deal 15 years ago, 20 years ago that went kaput. The 88 deal, I think. So there's a New York Times article. Bruce Wasserstein's sister is Wendy Wasserstein. She writes Broadway, but so they're big fixtures in the New York social circuit. The New York Times runs this big, magazine, the New York Times Sunday magazine. They have a big section on Bruce Wasserstein. They have a big interview with him. And the interviewer actually did a pretty good job instead of fawning over Bruce Wasserstein, how big deal maker. Yeah, she asked him on the Federated deal, he paid $70. How did he come up with the $70? He's supposed to be the M&A guru, and he said she expected an answer like we did the cash flows and the intrinsic value. And he came back and he said, well, that's what we had to pay to get the deal done. So she asked the follow-up question. Weren't you worried you were paying too much? And he said, my objective was to get the deal done first and worry about value afterwards. That should be on the tombstone of every M&A banker. Did deal first, worried about value afterwards. What's worrying about value afterwards going to do for you anyway? What are you going to do 2 years after the deal? Say, oh, you know what, we paid too much. Let's send a letter out to stockholders saying, can you please return 25 of the $70 that we paid 2 years ago? You can't worry about value afterwards. Once the deal is done, it's a fait accompli. You cannot do much. You can't claw the money back. If you're going to do analysis, it's got to be before the deal gets started. But I think the process is so skewed towards getting the deal done that often nobody wants to ask the question. Yes? Only if you're paying less than the value, right? Otherwise, I want a bidding war and I want you to lose. It's better to lose a bidding war than to win a bidding war. Right? And that's every large bidding war. That's the end result. Right? I mean, you've heard the auction's curse in an auction, right? What's the auction curse? The winner's curse in an auction. What's the winner's curse? You win in an auction, you always should have mixed feelings about what you've just pulled off. On the one hand, you won. Congratulations. On the other hand, think about it. You won because everybody else in the room thought you were paying too much. Next time you win an auction, remember that. So unless you have something special that you know that nobody else knows, you should always have mixed feelings. Same thing applies here. You have a winner's curse in auctions. That applies in spades when you talk about an acquisition. So it's pretty depressing what I've told you about acquisitions, right? So if you're going to M&A, you're saying, what the heck am I going into? So let me close this off at least with an optimistic thought. Let's assume you're going to work for a company that is dead set on doing acquisitions. So you want to kind of guide them at least towards the places where they have the best odds of success. So I'm going to ask you, on a series of cases, which would be a better target in an acquisition? Would you rather focus on public targets or private targets? What's the advantage of focusing on private targets? What's the problem with public targets? There's a market price and you've got to pay a premium on it, right? With private targets, you estimate the value, so you don't start off with this high number and build up on it. At least you get a chance. So private versus public. Would you rather have a small or a large target? The question I'm asking, would you rather do mergers of equals or mergers of unequals? Where do you think the odds of success are greater? Small targets seem to work better than large targets. And I'll back this up. Let's go back up. Would you rather pay with cash or pay with stock? I actually, when I looked at those choices, before I looked at the evidence, I went back and forth because there are pluses and minuses to both, right? You're saying if my stock price is overvalued, especially if I'm overvalued, then I should play with stock. The only problem is the minute you offer your stock as tender in a merger, what does the other side do? What do the target company stockholders do? And the minute they say you're offering stock, they say, well, you know what? They're offering stock because it's probably overvalued. I'm going to demand a larger premium. So it's a game, and you've got to decide what wins that game. We'll look at what the evidence actually suggests. Would you rather go for cost synergies or growth synergies? Which one did we say was easier to value? Cost synergies are easy to value. The evidence suggests that synergies that are growth synergies might be larger, but they're so much more difficult to value that you're far more likely to overpay for them and overestimate what they are than cost synergies. So here's the bottom line. If you look at acquisitions, it's kind of tough to read this graph. This actually looks at acquisitions based on the size of the target company relative to the acquiring company. So the blue are the small targets, the purple are the large targets. It looks at whether you pay cash, stock, or combination, and across all mergers. Let's take the all mergers. Your best chances of, so this is across all mergers, thousands of mergers in the U.S., the mergers that were most likely to succeed were really small targets, targets that were less than 6% of the acquiring company's size. The mergers that least likely to succeed were those large targets. Cash did a little better than stock. In fact, some of the worst acquisitions were large stock acquisitions of equal-sized companies. Okay? And in fact, if you build on them, public versus private companies, private businesses were far better targets or subsidiaries of public companies. Do you see why you still start with the advantage there? Since there's no market price of the subsidiary, especially the public companies in the throes of a restructuring, you might be able to get a subsidiary at a bargain. So private as opposed to public, small as opposed to large. Cash stock, depending on your stock price, looks at least historically that cash has done a little better. Okay. And you can see that the results could at least work in your favor, which effectively means that you should focus your energy on those places where the odds of succeeding are greatest. And with cost and growth synergies, historically, cost-saving synergies seem to be far more likely to be delivered than growth synergies are. The KPMG study that I talked about actually looked at that and found that cost synergy mergers were more often successful than growth synergies. So here's my bottom line on acquisitions. If you're going to succeed with acquisitions, I think you have to be disciplined. In other words, if something works for you, don't deviate from it. What made Cisco successful in the 1990s is they had a roadmap. They did the same thing over. They bought these small technology companies with a promising product, and they did it over and over again. But they never veered from it. Even as they got bigger, they stayed with that strategy. What got them into trouble in the late 90s and the early part of this decade was they found that these companies were too small to make a difference. They started expanding the size of the target company, and they discovered you scale up that much. So you have to be disciplined. If something works for you, you've got to stay with it. You can't just let people get away with saying, qualitative, let's pay the premium, let's hope that something good happens afterwards. But here's what I think makes the most difference. In every acquisition, if you work in a company or an acquisition is being pushed, there's somebody pushing really hard for that acquisition, right? Somebody at the top of the management says, you have to do this. Hold them responsible for the acquisition. It's amazing how quickly they will step back when that's the case. Okay, so you think it's a great idea? Okay, you'll be in charge of the acquisition. If it fails, you're fired. Let's see if they still stick with that objective. Let's do the acquisition at any cost. Because it's easy to throw numbers out there. It's very difficult to deliver those numbers. So take a look at the 7 tests. Hopefully you passed all 7. I'm sure you did. So on Wednesday, we'll talk about value enhancement and value control.